I want to show you something that confuses millions of beginners: the difference between trading and investing. These aren't just two fancy words for the same thing. They're completely different approaches to making money in financial markets. Trading is buying and selling frequently to profit from short-term price swings. Investing is buying assets and holding them for years to grow with the economy. Both can build wealth, but they work in totally different ways. Let's talk about trading first. When you trade, you're trying to profit from price movements that happen quickly, sometimes in minutes, sometimes in days or weeks. Traders buy low and sell high repeatedly, or even sell high and buy back low. The goal is to capture these short-term fluctuations before they reverse. To understand this, think of a stick figure staring at multiple screens, watching charts tick up and down every second. Now, time horizon matters enormously here. Traders operate on what we call short-term time frames. Day traders close all their positions before the market closes each day. They never hold overnight. Swing traders might hold for a few days or weeks, catching slightly longer price waves. But either way, we're talking about quick in and out moves, not years of patience. Trading comes with higher risk and volatility. Prices can spike or crash rapidly, and those swings magnify both your potential gains and your potential losses. One bad trade can wipe out days of profits. That's why professional traders use strict risk management, stop-loss orders, position sizing, and disciplined rules. Without these safeguards, trading becomes gambling. I've seen beginners lose thousands in their first month because they didn't respect the risk. The markets don't care about your hopes. They move based on millions of participants making split-second decisions. There are different styles of trading. Day trading means opening and closing positions within the same day. The pros? No overnight risk. You sleep without positions. The cons? Extremely high intensity and screen time. Swing trading means holding for days or weeks to catch bigger moves. Pros: fewer decisions, less minute-to-minute stress. Cons: you're exposed to overnight price gaps and news events. Both styles demand skill, focus, and emotional control. The thing is, most beginners underestimate how hard trading actually is. Quick gains are possible, but so are quick losses. And trading fees, commissions, and taxes eat into profits fast. Now let's flip to investing. Investing is fundamentally different. When you invest, you buy assets, stocks, bonds, funds, with the intention of holding them for years, even decades. You're not trying to time every wiggle in the market. Instead, you're betting that over the long run, the economy grows, companies become more valuable, and your portfolio grows with them. Think of a stick figure planting a tree and watering it patiently, year after year. Investors operate on a long-term time horizon. We're talking 5, 10, 20 years or more. The label here is long-term. Why does this matter? Because over long periods, short-term volatility smooths out. Markets go up and down daily, but historically, they trend upward over decades. Patience becomes your superpower. You're not glued to a screen. You check in periodically, rebalance occasionally, and let time do the heavy lifting. One of investing's most powerful forces is compound growth. When your investments earn returns, and those returns generate their own returns, you get a snowball effect. Reinvest your dividends, let your gains accumulate, and over time, the growth accelerates. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the math checks out. A stick figure pushing a tiny snowball that grows massive over time captures this perfectly. Investing also benefits from diversification, which lowers risk. Instead of betting everything on one stock or one trade, you spread your money across many assets, different companies, sectors, even countries. If one investment stumbles, others keep growing. Over long time horizons, this diversification smooths out volatility. Your portfolio might dip in a bad year, but historically, patient diversified investors recover and grow. The label here is lower risk if diversified. It's not zero risk, nothing is, but it's far less nerve-wracking than day-to-day trading. So what does this mean when we compare them directly? Let's break it down across key dimensions. Time. Traders monitor markets constantly, minutes, hours, days. Investors check in occasionally, quarterly, maybe monthly. A split-screen stick figure shows one frantically clicking, the other sipping coffee and glancing at a chart once a month. The difference in lifestyle is night and day. Traders sacrifice flexibility and peace of mind. Investors build wealth while living their lives. Risk and volatility. Trading exposes you to rapid, unpredictable swings. One headline can tank your position overnight. Investing smooths out those swings over years. Stress and effort. Traders face high stress, long screen hours, and constant decision fatigue. Investors enjoy calmer, lower maintenance routines. Returns. Traders aim for quick spikes. Some succeed, many don't. Investors historically capture steady compounding market returns, around 7 to 10% annually after inflation. Neither is guaranteed, but the effort to reward ratio differs dramatically. I know which one lets me sleep better at night. Which is better for beginners? The honest answer: most beginners should start with investing. Trading requires skill, experience, and emotional discipline that take years to develop. Jumping into day trading with no experience is like trying to run a marathon without training. You'll probably get hurt. Investing, on the other hand, is more forgiving. You can start small, learn as you go, and let time work in your favor. That said, trading isn't inherently bad, it's just harder. If you're genuinely interested, start by learning the basics, practicing with small amounts or simulators, and setting strict rules. But for building long-term wealth, especially as a beginner, investing is the safer, smarter path. A stick figure standing at a fork in the road, one sign pointing to trading with warning icons, the other to investing with a steady upward arrow, illustrates the choice clearly. So how do you actually get started? First, build an emergency fund, 3 to 6 months of expenses in cash. This keeps you from panic selling investments when life throws curveballs. Next, open a low-fee brokerage account. Look for platforms with zero or minimal commissions and access to diversified funds. Then, start with broad, low-cost index funds or ETFs. These give you instant diversification across hundreds of companies. Set clear goals: retirement, a house, financial independence. Knowing your why keeps you consistent. Write it down, make it real. Finally, automate. Set up automatic monthly contributions. This is called dollar cost averaging. You invest the same amount regularly, buying more shares when prices are low and fewer when high, smoothing out your entry points. Rebalance periodically, once or twice a year, to maintain your target mix of stocks and bonds. A stick figure setting up automatic transfers and checking a simple checklist makes this feel manageable, not overwhelming. Automation removes emotion from the equation. You're not tempted to time the market or panic during downturns. You just keep going, month after month, building wealth steadily. Let's wrap up with the key takeaways. 1. Know your time horizon. Short-term trading or long-term investing changes everything. 2. Manage risk. Never invest money you can't afford to lose, and diversify. 3. Costs matter. Fees and taxes eat returns, so minimize them. 4. Diversify. Don't put all your eggs in one basket. 5. Be consistent. Regular contributions and patience beat trying to time the market. A simple numbered list on screen with icons reinforces each point. The thing is, you don't need to be a genius or have a finance degree to build wealth. You just need to understand the basics, start small, and stay consistent. If you're just beginning, focus on learning the fundamentals: how markets work, what assets are, why diversification helps. Then take action. Open that account, make your first investment, automate your contributions. Keep learning, stay patient, and don't let fear or hype push you into decisions you don't understand. Stick figures walking confidently forward, one step at a time, remind us that every expert started exactly where you are now. Trading versus investing, broken down without the jargon. Both have their place, but for most beginners, investing is the smarter, calmer path to building wealth. Start with the basics, protect yourself with diversification and emergency funds, and let time work its magic. Keep learning, stay curious, and remember, every financial journey begins with a single step. Thanks for watching, and good luck on your path to financial freedom.